Thank you for joining us or rejoining us today. My name is Ashlyn Levitt, and I'm the Assistant Director of Events and Volunteer Management for Grand Valley's Alumni Relations Office. Through our partnership with Consumers Credit Union, we have invited you to join us for lunch as we address a variety of key financial topics. Over this 8-week series, we have dove deeper together and learned about identity theft, credit reports, scores, considering home ownership, and in today's final session, we will learn about mortgages. Before I hand it over to our presenters, I do have just a couple of Zoom keeping notes to reiterate here. This presentation is being recorded and will be accessible on our career and life stage resource library. Please feel free to submit questions throughout the presentation, and our presenters will address those as they are able. We will also save some additional time at the end to answer any questions. Our program will wrap up today right before 1 p.m. And with that, I'd like to thank our friends at Consumers Credit Union for partnering with us today to bring you this series. Today's program is led by two Grand Valley alumni, Gregg and Rustin. Gregg and Rustin, thank you for being here today.
Yeah, thanks for having us.
I'll let you take it away.
All right. Hi, everyone. For those of you that were with me on the Considering Homeownership webinar, welcome back. We're going to be covering mortgages today, as Ashlyn had mentioned. My name is Gregg Teegardin. I'm a residential mortgage manager and lender at Consumers Credit Union. I've been in mortgage lending for over 23 years now, graduated from Grand Valley State in 2001 with my finance degree. I actually got connected with somebody in the mortgage industry right out of college from the career counselor that I was seeing at Grand Valley. She connected me with a Grand Valley alumni. So it's a great resource if you haven't utilized that and not sure where you're going to go for work or your career. That's a great resource. So definitely utilize that. As Ashlyn mentioned, my co-presenter today is Rustin Scott. He's a Grand Valley alumni as well and a top realtor at 5 Star Real Estate. And how many years have you been in real estate, Rustin?
So I've been an agent for about 10 years, and before that I was in the lender role as a loan officer.
Yeah, so tons of knowledge on his side. If you're in need of a realtor, definitely hook up with Rustin if you're going to be out looking for a home. So getting into it, on the mortgage side of things here, just give a quick definition. We're going to be covering mortgages. As I mentioned, the cost associated with getting one and how to prepare for getting one. As Ashlyn mentioned as well, if you have any questions during my presentation, please raise your hand, use the raise hand react button there, and let Ashlyn know if you have any questions, and she can let me know as we're going through this. If you think of some at the end too, hopefully we'll have enough time. I'm going to try to cover as much material as possible here in the 30 minutes I have, and then I'm going to pass it over to Rustin for 10 minutes or so, 10, 15 minutes, and then we'll have probably 5 minutes for questions at the end too. So mortgages, bear with me here. I'm doing dual screens and doing my best to go through. So defining the term mortgage, a mortgage is a loan that you take out to purchase a property. Most people do not buy a home using only their own funds. According to the National Association of Realtors, 86% of homes are purchased using a mortgage. So it's pretty rare in this day and age to pay cash for a house unless somebody's rolling over a ton of equity from a house they currently own. But for first-time home buyers, you're going to need a mortgage. If you want to buy a house that costs $250,000, but you only have $10,000 to use towards the purchase price, you have to go to a lender like me to get a mortgage for a balance of $240,000. So you'd be financing $240,000 in that instance. While the total amount of your mortgage might be very high, you won't be paying it all back at once. Payments are spread over many years and are made monthly. The most standard term is a 30-year fixed. So you'd be making monthly payments, for 30 years. Most mortgages, people end up refinancing out of every 5 to 7 years on average, just because rates dip and it makes sense. Just a quick note on that. For a refinance that makes sense, you want to shave a point off your mortgage, a percentage point. So if you're sitting at 6.75 where the market's at currently, and rates get down to 5.75, then that's the time to start thinking about doing a refinance. Because there are costs every time you do a a mortgage or a refinance, you're going to have costs associated with that. So you want the monthly savings to be enough for that to benefit you. And that point is usually what does it. So getting some common mortgage terms that you should know about. When you get a mortgage, you're going to need to make monthly payments that will include the principal or original amount you borrowed. As I mentioned before, this needs to be paid back in full. So if you borrow the $250 and you pay back $150,000, you're still going to owe that $100,000 at the end of the mortgage. Pretty simple on that. Next is the interest on the amount you borrow. Banks earn a profit when they lend you money. They do this by charging you for the funds that you borrow. This fee is called interest. Your lender will determine an interest rate, which is a yearly percentage of the principal you owe. The higher the interest rate, the more you'll ultimately pay each month in interest. So that's where the refinance really makes sense, if you can get down to a lower interest rate. So hopefully in the next year or two, we'll be seeing a dip here. The next part of the monthly payment are property taxes. And I did talk about this in the considering homeownership. Just want to cover it again because it's very important. Property taxes are based on the millage rates for the area that you buy in and the taxable value on the home that you purchase. One important thing to note here, again, is that you're generally, when you first purchase the home, the current homeowners are going to have been in the house for quite some time. Generally, if they've been there a year, it won't be as drastic of a change. But once you move in there as the new homeowner, the assessor is going to bump that taxable value up. So your payment is going to go up from the initial monthly payment that you have on the mortgage, because you're going to have to adjust accordingly for the taxes going up. This is because the current homeowners are grandfathered into the home, and then when a new homeowner takes ownership, the assessor goes in and reassesses the taxable value. The jump is usually on average about 35% to account for. So if the taxes, just an example, are $3,000 on a home that you're buying, they're going to go up to $4,000 the following year. So you'd want to make sure you keep $1,000 back for that difference, and then your payment will adjust, accordingly as well moving forward. So you always want to plan on, $100, $150 a month more down the road for your monthly payment from where you start out at. And then once that change takes place in the property taxes, it's very rare for you to see a 35% jump. It's usually just that first adjustment. That's the big one. And then you'll just have a gradual increase from there, or decrease depending on, where values are at in the area. That first change is always going to be a little bit of a jump to plan for. The last part of your monthly payment are homeowners insurance and private mortgage insurance, if applicable. The homeowners insurance, you're going to shop that around just like a mortgage or want to. Generally, you'll go to where you have your car insurance at, because you'll get a multi-policy discount when you go for homeowners insurance. But I always recommend getting 2 or 3 quotes on that, just to make sure you're getting the best premium possible. Some of the bigger insurance companies have major increases right now in their premiums due to them covering nationally many homes that are involved in the disasters with hurricanes, so they're affected by that with the premium. So you always want to kind of shop that around and see if maybe you can get a local insurance company that is Michigan based, so you're not as affected by those premium jumps. When you purchase a home, the money used for the down payment, the funds are called a down payment that you put down on it. A down payment is money that you use from your own funds towards the purchase of a home. So if you have $10,000 in the bank and you buy a home for $250,000, you would make that $10,000 down payment and you'd have that $240,000 mortgage. Different loan programs require different minimum down payments. Regardless of the program you use, the down payment will generally be referred to as a percentage of the home cost and the dollar amount. For example, your lender might tell you need to make a 3% down payment. In the case of a $250,000 home, that means you need $7,500 as the down payment. So that's your down payment portion. And then you're going to have your closing costs and escrow on top of that, which I'll get into a little later here. So if you buy a house for $300,000, it's another example, you're going to need a down payment of $9,000. The reason I'm mentioning 3% is because first-time home buyers, that's the minimum with conventional loans that you can put down is 3%. So something you'd want to target for saving up for. The next cost to define on mortgage is the PMI. Generally, you're going to have PMI insurance if you're a first-time home buyer. Anytime you do less than 20% down, you're going to have PMI on the loan to account for Just realize the screen that we are on is not the either. Let me go back. So the PMI that will be on that loan until you get to an 80% equity position. So once you have 20% equity in the home, the PMI will fall off on a conventional loan. FHA, unfortunately, the PMI never comes off unless you refinance out of an FHA mortgage. So that's one positive to doing a conventional loan over FHA. I do have an example later that I'll show the comparison between those two options. And something else that I wanted to cover with you are mortgage points or discount points. You'll hear those terms tossed around with interest rates. So you can buy down the rate by paying a percentage of the loan amount to the bank up front, that's called points. The word point simply replaces the word percent. Your banker might tell you that the bank rate is currently at 6.5, but if you pay a quarter of a point, they can offer the rate at 6 1/4. If you're borrowing $250,000, a quarter of a point, which is the same as saying a quarter of a percent, would equal $625. So that's a cost that you would pay up front to buy the rate down from 6.5 to 6 1/4. The monthly savings going from 6.5 to 6 1/4 is $40 a month on a $250,000 loan amount. So if you do the math on that, if you take the $625 that you pay up front and you divide it by that $40 savings per month, it's going to be a break even of 15 months before you'd make your money back. So it's a little bit of a risk because if rates dip and you refinance, in the first 6 months to a year, and I have had clients that have done that locked in the mid 7s 10 months ago. Now they're refinancing when rates were down. Rates are back up, in the high 6s, but they were down in the low 6s 3 weeks ago. So I had a lot of clients that were refinancing 10 months later. So it wouldn't make sense to buy the rate down if you think rates are going to dip. So it just depends on that break even. So you always want to ask the lender to give you what the monthly savings is with the buy down and then what the upfront cost is. So you can divide the savings into that amount you're paying up front to know what your break even is. And then you can make a good decision on that. I tend to not recommend buying points down in a market like this just because rates are higher and it's likely they're going to come down. So that you usually don't make your money back in the time before you refinance. When rates were 3% all day long, I recommended buying it down because likely you're never going to refinance if you have a 3% interest rate. So if you can buy it down to 2.75 when we were down there, or even in the 4s, then I definitely recommend it. But generally, when we're sitting around 7%, I don't recommend doing the buy down. So lastly, you have some other fees such as an appraisal, which ensures the value of the home is accurate, title insurance to guarantee that the seller actually owns the house and there aren't any outstanding liens against it when you take possession, and then bank-related fees for the mortgage, such as a credit report, underwriting, and processing fees to account for. When you apply for a mortgage, your bank will provide an estimate of all these costs so you'll know what to expect. So when you're going for a pre-approval, you're going to want to ask for a loan estimate or a cost worksheet, especially if you're shopping around and you want to compare fees from one bank to a next or interest rates. You want to ask for that so you can do that. Make sure you're getting the best deal possible. A good estimate to use for closing costs and an escrow account setup for property taxes and homeowners insurance is 3% of the purchase price. So just like the down payment requirement, 3% for first-time home buyers, you generally want to account for another 3% of the purchase price towards closing costs and escrow. So just keep that in mind. So a $250,000 house, you're going to have $7,500 in estimated closing costs and escrows, plus the down payment requirement. So just an idea of what you'll need to save up for. One thing to note here, and Rustin might cringe, but you can ask the sellers to pay for your closing costs within your offer. So if you don't have, the down payment of 3% plus, the closing costs and escrow, you just have enough for the down payment, you can ask the seller to do what's called a seller concession or a seller credit, where they'll pay your closing costs out of their proceeds. So it's essentially baked into the purchase price and your loan amount, but that way you don't have to come up with the additional, $7,000 out of pocket plus the down payment. If it's a tough, market where it's super competitive on a home, you're not going to want to ask for that if there's multiple offers, because you'll likely not win the offer if you're going against, other buyers that aren't asking for that. But if it's a situation where you have the highest offer and you're asking for that, then something definitely worth looking into if you want to stay, liquid and keep your money in the bank. That's something you'd want to lean on your realtor for. They'd be able to let you know if that's a good idea or not on the home that you're looking to make an offer on. So the next slide here, we want to get into how to prepare for a mortgage. The first step you want to do is plan for a budget. Let's get a budget together so you know how much you can afford for a mortgage. Generally, what you're paying in rent. If you're renting, you want to keep your mortgage payment close to that if you can. Obviously, your income over time will continue to go up, but try to stay close to what your current rent is if you're comfortable with that. If you're easily making rent payments and you have a lot more disposable, then you can perhaps go up on what the mortgage payment would be. So talking about how to prepare for a mortgage, if you're only thinking of buying a house, it's never too early to begin preparing for it. The more time you have to get yourself ready, the better off you'll be. So knowing how much you earn, spend, and save each month can help you figure out how much of a mortgage and down payment you can afford. Adjusting your spending and saving habits now, even if you're a few years away from home ownership, can put you in a better position to improve your credit score and get a mortgage with favorable terms. So make sure, like I said, to create a budget first, to give you a clear picture of what your finances are and what price range you should be looking at. A lender is going to help you determine that as well. I'll have clients that call me for pre-approval, and I'll go through all the numbers with them, pull their credit, and let them know what comfortably what range they should be in. It's always a little bit less than what the maximum is, just because I like to keep my clients with as much disposable as possible, so they have a life outside of their home. So just keep that in mind too, that you don't necessarily want to go to the top of your budget for a home. So whether you want to buy a house, plan a trip, or save for any other goal, a budget is the first important step there. A couple important questions to ask yourself in regards to being ready to buy a home. Do you have more monthly debt payments than monthly income currently? If so, it's not the right time likely to be looking to add more debt with a mortgage. So you want to focus on paying those debts down over the next year or two and then revisit purchasing a home. Another thing to consider is, are you able to save money for a down payment, or have you currently? There are zero down programs available. We have one unique to us at Consumers. You have VA that's zero down if you're a veteran. There's rural development as well. The only thing with that is you're generally going to pay a higher interest rate, initially on those loans, and you're going to have more cost. But if you're really wanting to get into, a home and invest in a property, start building some equity, then there are zero down products available. Putting a down payment down just allows you, more options, and I'd say better interest rates and lower costs. So just something to keep in mind. So after creating the budget, and I'll go through an example at the end here of a budget based on a salary, kind of give you an idea of how to work your own budget. But the next thing you want to do is find out what your credit score is. A good credit score can also mean a lower interest rate. To get the best interest rates and qualify for the lower down payment and cost on mortgages, you'll need a 700 plus is the ideal credit score to be at. That's where you can get the best interest rates as a first-time homebuyer, especially. If you start getting below 700, then you're going to have higher interest rates, and you're going to want to work on boosting your credit up if possible. And lenders can help you do that, or tell you what you can do to do that. The biggest thing, if your scores are sub 700, that you can do to boost your scores is if you have credit cards. If you're above 30% on your balances to what the limits are, you're going to want to pay those down below the 30% utilization. If somebody has 3 or 4 credit cards, when I pull credit and they're all maxed out, let's say their total balances are 10,000 and they have let's say their total balances are 10,000 and they have $12,000 total as their limits, that the system views them as being maxed out. So I tell them to get that paid down to 30%, of the overall, the 12,000. So it calculates, when you go on the credit, it takes the total limits of all of your revolving debt, all of your credit cards, adds that up and adds up all of your balances. So that's an easy way to get your scores boosted quickly. And we do have a credit expert system we can use. And when we pull it, it tells you exactly what doing specific debts, paying them down, will do for your credit. But the biggest thing it's always just being at 30% of the available limit. So keep that in mind. In credit, you might pay your credit card off monthly. or pay the balance down, but a lot of times they don't report at the end or the first of the month. They report at odd times to the credit bureaus. So you always want to stay at that 30% if you can. Don't get up over, definitely don't get up over 50%. So if you're able to increase your credit lines, that's beneficial as well. Obviously, don't use more than the 50% or 30% if you can.
Greg, we did have a question come in here.
Yep.
Someone in the chat asked, is this the best interest rate, or is the best interest rate roughly the average interest rate? For example, 6 or 7%, or is it possible to get a lower credit score if you have a strong credit score?
A lower rate if you have a
lower
strong credit
interest
score?
rate.
Yeah. Yeah, so the higher the credit score you have, the better rate you're always going to get. First-time home buyers get a little bit of a break. So if you're 700 plus, it takes away the hits that you normally would have. Repeat home buyers need a 780 plus to get the best interest rate if they're not first-time home buyers, and then it goes in 20-point increments for add-ons to the rate. So if you're between 760 and 780, you're going to have a little add-on. If you're 740 to 760, more of an add-on, so on and so forth for repeat home buyers. First-time home buyers, as long as they're 700 plus, you'll get the best interest rate out there. If you start getting below 700, then you're going to have higher rates, higher costs. You're likely going to have to go FHA too if you start getting below 680 on the credit. So that's where talking to a mortgage lender early on is beneficial, because we'll pull your credit and we'll know what you can do to boost your scores and let you know exactly what your credit score is. Because a lot of the free credit reports that you see out there, they're never the same as what we pull on our side for a mortgage. There's always a discrepancy there. We're generally lower than what you're going to see on the free credit reports out there. And we also pull 3 scores for a mortgage, and we use the middle of the 3, which I talked about in the last webinar, but we use the middle of 3. A lot of times when you get a free credit report, it only has 1 score on there. If you go for an auto loan, there's only going to be one. They only pull TransUnion. So if you're thinking of purchasing a home, I definitely would recommend having your credit pulled so you can work through that with a lender and start working on getting your credit up if need be. But it's good to know where your score is.
Hey, Greg.
Yeah.
Shelly also asked a question and I kind of answered, but you might want to touch on that. But based on what you're talking about, like, it is super important to kind of get a game plan together, because there might be a really simple thing you can do on your credit report that Greg can look at and go, oh man, this is wrong on your credit report. Or, if you pay down this credit card by maybe $100 to $200, in 30 days, you might see your score literally boost like 50 to 100 points. And so just having that conversation somewhat early on, even if you might be a few months out from buying, makes a whole lot of sense, because then you can get the best terms that you possibly can based off of your credit rating, because every 20 points, and maybe even less than that now, there's an adjustment. It's called a loan level price adjustment, where you're going to have a different rate. Or maybe you have to pay more points to get a certain rate and things like that. So, I just wanted to kind of jump in there because I was answering this question. But if you got anything else to say, go ahead, Greg.
I appreciate it. Yeah. So definitely the earlier you can get the credit pulled to see, a lot of times it is just paying 1 credit card down. Or I've had it before, if you just get your name off as an authorized user on a credit card that you're on with a parent or somebody else. Just getting removed as an authorized user can boost your score, 20, 30 points. So it's a lot of times it's a lot easier than what you think to boost it up there. But the last thing you want to do is have a house that you want to make an offer on. You have a short window there, and you don't have time to improve your credit, because if you don't have enough time to improve it, then you're going to be stuck with that higher interest rate. So definitely be proactive and having your credit pulled. You're going to be shopping for a mortgage.
Yeah, let me just give you a real quick example from personal experience. I moved out of a house, and I pulled my credit score probably 30, 60 days later, and my scores literally dropped 100 points, and I couldn't figure out what was going on. So I dove deeper into my credit report, and I had an $11 collection from DTE Energy for my last heating bill that apparently didn't get paid. They had all of my forwarding information. They had my phone number, they had my address and all that stuff. So I kindly called them. They sent it to collections. I didn't know anything about it. This was probably more like 6 months after I'd moved out. And so my scores dropped 100 points. I was so upset about it. And so I called DTE and I talked to them, and they were really nice about it. And they were like, yep, we're sorry, that this happened. You should have been forwarded this information. But they were able to take that off of my credit report, and my scores went back up to 100 points literally 30 days later. So it is just super essential to do this at least probably, I don't know, 60 to 90 days before you even think about buying, just so you have that window of opportunity to fix anything that might be wrong on your report. I mean, it happens more than you think.
Yeah.
And there's all these little things that you can do to improve that. And it just goes a long way in the long run. So anyways, that's one scenario.
Appreciate it. I couldn't agree more. And not all lenders are going to, it is just so you know how in mortgage lenders, we're paid when a loan closes. So, a lot of lenders aren't going to do, unfortunately, the work up front, with credit to help you repair it. So you want to work with a mortgage lender too that's willing to pull your credit and that has the credit expert system that will work with you in boosting your scores up to get the best interest rate possible. Because again, this is something you might have for, depending if you refinance or not, you might have for 30 years. You can do a 20-year term or a 15-year term too, but most people do a 30-year term. So it's definitely crucial to work with a lender that's going to help you, boost those scores up so you can get the best interest rate starting out and get off the right foot. So another thing to plan for when you're going for a mortgage is we're going to have to collect documents from you as a mortgage lender. So we generally have to get 2 years of tax returns and W-2s from you. So right now I'm asking clients for their 2023 W-2s and tax returns and their 2022. We also need to get your 2 most recent paychecks. So you want to make sure you keep these documents all readily accessible. If you have it in a PDF, you can upload it. Generally, most mortgage lenders have. We have a fast app at Consumers where you can just upload documents, make it real easy. And we're always going to want your past 2-year employment history and residence history as well. And then bank statements, we want to see your last 2 months of bank statements. So just some things to mention here, which I mentioned on the other webinar, is if you're part-time and you haven't been part-time for 2 years, that can cause issues for getting a mortgage. Just because there's inconsistent hours with part-time, we have to show a 2-year history of part-time income. And if you're self-employed, own your own business, or if you're 1099 and don't get taxes taken out of your paycheck, same thing. We need to generally see a 2-year history of that. If you're W-2'd, or if you're just starting a job and you have an employment, a contract letter, an offer letter, we can use that. If it's going to be a W-2 position, you don't have to be there. That could be something you're starting in the next 90 days and we can use an offer letter. Or if you've only been at a job for 2 months and you're full-time and you're W-2'd, we can use that income. It's just when you're self-employed or when you are part-time that we need that 2-year history. Sometimes we can get away with 1.5 years, but it really limits your options for getting finance. So just something to keep in mind as you're preparing for a mortgage. If you're thinking of starting your own business, you're generally, it's kind of a catch-22. Also, when you have your own business, when you go for a mortgage, we're using what's on your bottom line. So if you do a Schedule C, after all your expenses, that's what we're using to qualify you, not the top, not your sales and receipts and services on the top line, not your gross. So it works a little differently. We're going off that bottom line. So it really does limit you because, for tax purposes, you want to write off as much as possible when you own a business. But for a mortgage, we want you to show as much as possible. So if somebody's W-2'd, I usually recommend, or if they're, W-2'd and thinking about going out on their own and they want to get a mortgage, I usually recommend waiting until, after we close to leave their W-2 position. Because once you close on a mortgage, then you can make the change if that's the route you're going to go, going to being self-employed, or if you're going to have a change of employment, I generally recommend, waiting on that if you can. So other thing to do while preparing for a mortgage is you want to calculate home affordability. So you want to look at your budgets, as we mentioned. There's a mortgage calculator you can use online to get an idea of what a payment would be. I'll give you kind of a sliding scale here in a little bit too, if time permits, but mortgagecalculator.org, you can go on there and run some scenarios, for a price range you're kind of thinking, just to get an idea of what to expect. Just keep in mind, you're going to have real estate taxes and homeowners insurance, that's going to get added to your principal and interest. A mortgage lender too, when you're getting the credit pulled, we'll run all those numbers for you. Something else to do when preparing is to research. Make sure you research mortgage companies. All of us do tend to have different, loan options available, like our zero down, as I mentioned. A lot of banks will only do zero down for doctors or teachers. We'll do it for anybody that has a full-time job and has a 700 credit score. So we're definitely, we have a niche there, but other lenders may have niches in other areas too. So it's definitely something to recommend would be to shop around a little bit, ask what the fees are, get your loan estimate, compare interest rates. One thing to mention on interest rates is they do change daily, just like the stock market, and they can change throughout the day. So if you're getting a quote now on a house, you're just getting pre-approved, and you don't, I should say first, if you don't have a house picked out, you're getting pre-approved to know, what price range you should be looking in. The interest rate on that day isn't going to be the same rate as when you go to lock it in. So just, keep that in mind. If you get a quote on a rate from a lender, that's not going to be your rate when you go to lock it in. We don't lock a rate in until you have an accepted offer on a house. So once you have, an accepted offer, Rustin sends that over, then we can go and lock your rate. So it's going to be contingent, where pricing is at, where rates are at that day. So I've mentioned already, the last step here preparing is get pre-approved for a mortgage. So in doing that, you're going to provide your annual income, you're going to go over your assets, you're going to go over your credit history. When you're pre-approved for a mortgage, that's telling the sellers out there that you've met with the lender, we've gone over your income with you, we've gone over your debt to income ratios, we've gone over your credit scores, your down payment, and you're financially stable to purchase a house, in the price range that the seller's home is in. So that we'll issue a letter to your realtor, and they'll use that to submit with your offer. So just different types of mortgages out there. Get to the next screen here. The two primary types of mortgages that you'll see out there are conventional mortgages, which are Freddie Mac and Fannie Mae, and governmental, which are FHA, RD, VA, and MSHDA. If you have a 680 credit score, then a conventional mortgage is generally the route to go, since they have much less fees than governmental loans do. I'll show a comparison on the next slide here, just so you can see the difference between conventional and FHA. Something to keep in mind as a buyer too, sellers tend to, because they're advised by their realtors, and Rustin can attest to this, if you have multiple offers coming in a house and they're comparable in terms of, you have the same offer, say at 250, and one is a conventional, one's an FHA pre-approval letter, the seller is generally going to go with that conventional pre-approval letter, conventional buyer. The reason is because there's a lot more hoops to jump through for a seller on a governmental loan with FHA or RD. The appraisals are more strict on the house. There's a lot more red tape on it, and it generally means the borrower is not as well qualified as well if they're going FHA. Because if you're above 680, you're more than likely going to be going conventional. So it's known that it's usually the scores are a little bit lower. The only time where FHA really makes sense and where I'd recommend using it is if you're buying a multi-unit property, like a 2 to 4 unit. You can do those FHA with as little as 3.5% down. So it's definitely something to consider on that side of things. So going into an example between a conventional and an FHA mortgage here, just kind of show you the numbers broken down. So a 30-year fixed FHA mortgage, the rates are actually comparable between FHA and conventional, even with lower scores. FHA tends to have better interest rates than conventional if you're 680 or lower. The big difference, though, is that with FHA, they require 3.5% down, but half of your down payment they put back on the end of the loan amount. So you put 3.5% down, but then 1.75% of that's essentially taken and added to the back of your end of your loan amount eats into your equity position. So that's the main reason I don't recommend FHA is because they're taking half your down payment and putting it on the back end. That's how they're able to do these loans, because the amount of insurance and mortgage insurance that they charge in their loans just covers them risk-wise with lower credit scores. The total monthly payment with FHA is $2,107 compared to the $2,058. Sorry about that. The $2,058 with conventional. Conventional only requires 3% down, and it still has a cheaper payment because of that upfront MI, that 1.75 premium that gets added back on with FHA. So if you can go conventional, I definitely recommend it. And if you can, get your scores pulled early enough so you don't have to go FHA, I definitely recommend it as well. Just so you're in a better position with your pre-approval letter, you're more apt to get your offer accepted, and you're gonna get better terms as well. The other FHA is the PMI on those loans, the monthly MI of the 110 a month you see there, that never goes away in an FHA loan. It's on for the life of it. So the only way to get out of it is to refinance. Whereas with conventional, that 110 a month is going to go away once you get to a 20% equity position. You don't have to refinance to get rid of that. Just some different lenders that you'll see out there: mortgage lenders, banks, credit unions. Let me go back here. I'm going to kind of speed through the last few slides here so we can get Rustin some time too. So going for a mortgage, you're essentially, it's going to be the same places you go for a personal loan, auto loans, student loans, business loans. Banks, credit unions, and savings and loan associations, we're all similar. The majority of us will service our mortgages, meaning that you're going to make your payments to us. Whereas with mortgage bankers and mortgage brokers, a lot of the time they sell the mortgage. So what that means is they're gonna underwrite it for you. They're gonna take you through the whole process of the loan, but then at the end, you're gonna be making payments to a different financial institution. So I will say a lot of borrowers don't like that, because the mortgage gets sold to a national company, and then they're having to make payments to somebody that's not local. Everyone has their preference on that. The other nice thing about working with the bank or credit union is that you can have everything under one roof. We're a depository. We have a depository side too for checking and savings. So you can have those accounts with us, car loans and such. Whereas with mortgage brokers and bankers, they're just going to do mortgages solely. So the mortgage application process, the next slide I just want to cover here quickly. First step is you're going to want to get pre-approved, as we mentioned. Now, there isn't something to note too. There aren't any costs associated with getting pre-approved. So when you get your credit pulled, we don't charge you for a credit report. We don't charge you an application fee. So there aren't any cost out there. Most banks, credit unions, even mortgage brokers, they don't charge an upfront fee. So you don't have to worry about paying anything. Essentially, it's a free service to let you know, what you can qualify up to, and we're going to give you your budget. One thing too, during this process, make sure you ask for a loan estimate from the lender, because that's going to break down all the costs. You can compare, from one lender to the next. And the funds for your down payment, that if you don't do the zero down, you have to come up with the money. We do need to show the money's either in your personal checking or savings. You can get loans from your 401k too. First-time homebuyers, they'll allow that. So something you talk to your plan administrator about. I've had a lot of homebuyers that have utilized their 401ks for the down payment. The other option is you can get a gift from family as well. It's an example, from a parent. So the big thing to keep in mind, between when you're comparing mortgage lenders too, something to mention is that, which I did earlier, is that interest rates change daily. So if you're getting a rate quote from one lender on a Tuesday, and then Friday you're getting it from another mortgage lender, you're going to want to get the rate quotes within the hour if you can, same day, to know truly who has the better interest rate. Just because, like I said, rates change daily, and they change sometimes a couple times a day. So for shopping around, just make sure you're getting it the same day within the hour if you can. And then the last step of the mortgage process, to keep it, you're going to be, so after you do the pre-approval, after you get the accepted offer, the loan is going to be put in a process at that point. That's when we'll go in, we'll lock your interest rate. The loan disclosures, are going to get sent to you to sign, to get the loan in motion for the mortgage. It's the cost, the only upfront cost you generally have at that point is for the appraisal, which is $550. So that's something you'd pay for upfront in the beginning of the process. And then the rest of the costs aren't paid, including the down payment, until the loan closes. So when you sign and when you get an offer signed with the purchase agreement, it's generally going to be on average 25 to 30 days before you're closing. So just something to keep in mind too, that you do have time. If you're getting money out of your 401k, you'll have time to access those funds. Or if you're waiting on, a bonus to come in, as long as it's coming in that window before you close and you know 100% that you're getting the bonus or commission check, then you have time, for those funds to get into your account. And this last thing I want to cover with you here before I hand it over to Rustin, I just want to go through just a budget with you. So if you have a piece of paper and pen handy, or if you want to use the notes in your phone and use your calculator on your phone, I'll just take you through a quick example here of how to calculate a budget. I'll hand it over to you, Rustin. So you're going to want to take your gross monthly income. So that would be your annual salary. You want to divide that by 12 months. Or if you're hourly, you're going to take your average hours each week. So if it's 40 hours times your hourly wage, and you'll multiply that by 52 weeks divided by 12. So again, if your annual salary, if you have a salary, divide that by 12, simple on that. If you are hourly, take the hourly wage times 40 hours times 52 weeks divided by 12. And then for a mortgage, the max that you'll generally be able to go up to is 45% of that amount with your debt load. So your debt load would include anything that's on your credit report. So if you go ahead and take your credit cards that you have, the minimum payments on those, you want to add those up. So whatever your credit cards are, add the minimum payments up. And then for student loans, if you have those like I did when I graduated from Grand Valley, even if they're deferred, we're still gonna use a payment for those. We can't put zero in for student loans. So that's a big thing to keep in mind too, is that your student loans are going to be counted into your debt ratio. So you're going to need to take whatever the balance is on your student loans, multiply that by 1%, and then divide that number by 2. So that's the monthly payment that we're going to, essentially it's a 0.5% of the balance. We're going to use that into the calculation for your debt ratio. So add up the credit card minimum payments, the student loans, and then take your car loans. If you have any monthly car loans, personal loans, or installment loans, if you add those up, so whatever that monthly payment amount is, you're going to subtract that off the 45% of your gross monthly income. And that number that you have left is what you have room for a mortgage with taxes and insurance included. Just to give you an idea, a $250,000 purchase price, that scenario I went over earlier, the monthly payment on that was $2,000 to $2,100 per month is what you'd want to estimate for that price range in the 250 range. That's with 3% down. So if your budget allows for that, the other thing is it's household income. So if you have a spouse or a partner that's going to be going on the mortgage with you, then you're going to want to count, add their income in as well, either their salary or their hourly. So add that to yours, do the 45% of that, and then subtract out, any debts you currently have. It's only debts that are on your credit report too that we factor in. We don't factor in utility bills. So it'd only be what's showing up on your credit report for payments. Again, as I said before, my recommendation definitely is to stay at 35% if you can, though, of your gross monthly income. You can go up to 45 as your max. I always will let borrowers know what their max is, but I tend to, tell them to stay in that 35 to 40%, just so they're not putting themselves in a bad position with the mortgage payment. I like to make sure that they have a healthy amount of disposable income. So before I hand it over to Russ, I just want to throw a lot of numbers out there. Do you have any questions out there on creating the budget or what factors into it on the income side of things? All right, I'm gonna go ahead and hand it over to you, Rustin.
Okay, so we've just got a few minutes left, so I'm gonna just kind of touch on a few things. Let me get my screen up here. think everybody can see this, right?
Yep.
Does
all
that
good.
does that look right? Okay.
Yep.
So Greg touched on a lot of stuff, and all of it's really, really good. And it's really important to have a really good loan officer when you go to shop for a mortgage, especially as a first-time home buyer. I'd also recommend that you use somebody local if possible, so you can actually sit down and go through the process and understand all the ins and outs of what he's talking about, because there's a lot there to cover. And it's just really important to have a really good sit down understanding of everything involved into the process. So um, first thing I always ask people is number one, before we even go look at houses, you need a pre-approval. And so not only do you need a pre-approval, but I need to know as a realtor what type of loan you're getting, because that's going to make an impact on what houses we actually go look at, and then which houses we're looking at, what to look for. And I'm going to touch on that in a second here. But so obviously step one, pre-approval for the mortgage, and then we go out house hunting, making an offer, closing process, pretty self-explanatory there. Um, then obviously like choosing the right home. I touched on this last time too, so I'm not going to spend a lot of time on this one. But obviously take into consideration everything that you need and your family might need in a house, and think about things like resale. I always want to touch on that. But there's different types of loans, obviously, and Greg touched on a few of them. There's FHA loans, there's VA loans, conventional loans, and then there's something called USDA loans, or also called RD loans. Those are U.S. Department of Agricultural loans, and those are for more rural areas. These are all really great programs. The thing about them is, depending on the loan type you're getting, one house may or may not be eligible for that loan type. And obviously that's something that your realtor should be looking for also when they're going through homes, because it's just going to be a huge disservice to get through the whole process. You have an appraiser go out to the home and then they flag everything in the house and say, well, in order for this house to go into an FHA loan or a VA loan, it needs $10,000 in repairs or more, and then you just wasted a ton of money on inspections, appraisal, and a lot of time and effort too. So that's all really important to know going into it. Things that you're looking for as an agent when you're going through homes and you have a buyer that has an FHA or VA loan. Number one, safety and structural issues. They're going to look at the foundation, make sure utilities are working, looking for past water damage, because that might mean there's mold somewhere. Another thing that they look for is tripping hazards. I've had appraisers flag concrete that's not level in the driveway. I mean, simple things like that can come up, and those can end up being deal breakers, or they can be a really costly fix for either the buyer or the seller, depending on how the negotiations go. Other things is peeling paint. Any house built prior to 1978 has a potential of having lead-based paint in it, and that's an issue. So anytime there's peeling paint, an appraiser is going to point that out, even if the house is built after 1978. I see it all the time. People are like, well, it doesn't matter, it doesn't have lead in it. Well, they're still going to flag it. So it's something that you have to look for, like rotting wood and things like that, even on the exterior of the home. I have literally been out in the middle of winter using paint and scraping paint and then painting it just to make sure that we can actually close. Other things, everything needs to be in working order. Areas need to be heated. So like, have a proper escape for bedrooms, things like that. So that's all stuff that an appraiser is going to look for. Now, before you even have an appraiser out there, you're going to have an inspector out there. A good inspector will usually point some of these things out also. But they can be missed, or if you're waiving inspections or something like that, then maybe it doesn't come up, and then you end up having this problem later. So I can't touch on this enough. I think that it's really important to have an agent that's looking for these things when they're going through the home with you, so that you can address it up front or before you even make your offer. Because I've had it where we say in the offer, hey, this needs to be fixed prior to home inspections and appraisal. And then fine, it's taken care of. But that's all stuff to talk about. I touched on this last time. It's good to know kind of what to expect once your offer is accepted. But this is a key thing I wanted to touch on, what not to do once you have your house under contract. So everybody's all excited. You got your house under contract, and that's what I would call halftime. So then you still have the second half of the whole process to go through. So you need to get Gregg all of your documents, maybe update documents. Then you have the inspection, you have the appraisal, and then there's a lot of things that people will do during the process that will completely throw a wrench in it, and maybe even you can't even close. I mean, now this doesn't really typically happen for me or the lenders that I work with, because they're good lenders and they tell you these things. But things you don't want to do. You don't want to go buy a new truck or something 2 days before closing. You're not going to be able to close. You may still eventually close, but you're going to delay the process. Don't deposit large sums of cash, because they have to trace where all the money's coming from. There's a whole lot that goes into that. We're not going to get into all that. But you can kind of read through these. I think you guys are going to get the slides, and I want to leave some time here for questions. But don't go to like JCPenney and apply for a credit card, because then you're going to have a letter of explanation on why you have a new credit pull, because they will do a soft pull before you close, right, Gregg?
Correct. Yeah. So we're going to re-pull. It's not full on inquiry, but we're going to check to see if any other debts have been opened up since we started the process.
Yep. So these are the things not to do, because it will literally destroy the whole process for you. Other than that, Gregg touched on the taxable value versus assessed value. We stressed this last time too. It's super important. Just make sure that these calculations are being looked at by either your loan officer or your realtor should bring these up. Anytime I go through a house, I always point out, hey, there's a huge discrepancy between the taxable value and assessed value here. Otherwise, there's a couple other things on here that if we had time, I was going to touch on, but some nice graphs that explain kind of the market conditions right now in Grand Rapids. And I think that was pretty much it. I think it's frozen, but let's leave it at that. If there's any questions, I know we're kind of out of time here, but ask them now, or you can shoot us an email.
Thank you so much. So we didn't really have any questions come into the chat that are unanswered. I know it looked like Gregg was maybe answering the one that's in there. But now is your opportunity, if you would like to ask any follow-ups to our presenters here. All right, well, with that, I'd like to thank everyone for joining us this afternoon. And please join me in thanking Rustin and Gregg for sharing their time and their expertise with us. We cannot thank you and Consumers Credit Union enough for your assistance in bringing us applicable financial programming to our alumni throughout the past 8 weeks. Please keep your eyes on your emails, as we'll be sending a follow-up email to you later this week. This will include a post-event survey and links not just to today's presentation, but to any of the other presentations you would be interested in tapping into again. Lastly, please remember that as Grand Valley alumni, our commitment to you is as a Laker for a lifetime. We will always be alongside you and all of our alumni, ready to help you reach your next goals. No matter what stage of your life or career, you can turn to us for a lifetime of support. And with that in mind, you can find both additional resources and future events by checking out our website, gvsu.edu/alumni. Thank you so much.
Thank you.
Thanks, everyone. Go Lakers.